Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So buyers and sellers, I went through that. If buyers and sellers have different goals, so buyers and sellers have much different goals. If you have lost audio, you can go up to communicate, teleconference, and join the conference. And basically, you can go to information and call in. Okay, AS, so you could do that. Thank you. Option buyers prefer limited risk, and sellers prefer the option premiums, but they're willing to take more risk because they're looking to increase the income that's coming into their account. Here are the four positions for options. If you think about it, you have someone that's long a call, they have the right to buy. If someone is long a put, they have the right to sell. What are they preferring? Well, they prefer a large move to the upside, but they have limited risk. And if that person that wants to have limited risk but is bearish on the market, they can buy a put option. They have the right to sell. So you have the right to buy, right to sell, or I'm going to circle these just so you're aware. You have number one, the right to buy. Number two, the right to sell. Number three, you could sell a call and you have an obligation to sell, but you're not guaranteed to sell. And you have the right, you have the obligation to buy if you sell a put. So if you buy an option, you have limited risk. If you sell an option, you have obligations, but you don't have guarantees. The seller prefers to keep the premium, of course. That's what they get. And they hope the market stays in a range. So who's been winning, quote unquote winning, over the last 7 or 8 months? Buyers or sellers of options? In general. I'm sure there are instances where this is not true, but in general, who's been winning, buyers or sellers? When you see a lack of movement. Well, we've got 2 people telling me the buyers, but 3 people can tell me the buyers. Sellers are actually, thank you guys, now we're getting some more. Sellers are winning. Why do I say that? Well, if you think about it, when I say winning, where's the trend been? People, and this is the way we act as humans, it's just the behavior of us is that when something's working, well, we want to keep doing that. And if you look at the trend of that yellow line, what is it, up or down? Well, it's down, meaning that people have now started to avoid option premiums, and they've been doing that for the last 11 months or so, 10 months, whatever. So sellers have been benefiting from a lack of movement in the market. So today when we saw some would say it was a big move. It was only 1.6%, not a huge move. What is a huge move in my mind? A huge move in the market is, well, I would say, I don't know, 3%, 3.5%. That would be a huge move in the market. So we saw a considerable move, but not enough probably to scare a lot of people. We'll see. You know, what the markets are about dealing with managing risk. So here are the 4 positions. I hope everyone understands. It's very important. This is the basics of options, understanding the right to buy, the right to sell, the obligation to sell, and the obligation to buy. We're always talking about potential movement. Options are priced based on your expected movement. So simply stated, if you believe the market will have a greater move, so if I thought the market was going to make a 4 or 5% move, let's say tomorrow, would I have been a buyer or a seller of an option today? If I thought the market was going to make a big move tomorrow, let's just say even 3%. If I thought the market was going to make a 3% move, or even 2%. Thank you, Ken. You're right, buyer. Because, you get time, you'll have some theta, some time decay, but if you get a greater move than the market's expecting, well, that's the whole idea of the concept of buying or selling options. So if you sell options, you're expecting less movement, and if you're a buyer of an option, you're expecting more movement. Thank you for your answers. So let's talk about covered calls. What is the definition? I just spent 25 minutes or so forming the foundation for covered calls. I hope you understand buyer and selling. Now we're going to talk about covered calls. The covered call strategy is a strategy in which the investor writes a call option while at the same time owning an equivalent number of shares of the underlying stock, ETF, what have you. If this stock is purchased simultaneously with writing the call contract, or of course we could use ETF, the strategy is commonly referred to as a buy right. So what are the rights and obligations? Very important to understand. Options are contracts. They give the owner the right to buy or sell an asset at a fixed price for a specific period of time. And again, they obligate the seller to take the opposite side if and when the option is exercised, which means that you would be assigned. The covered call ETF strategy involves an obligation to sell the ETF at a certain price by a certain time. So would it make sense if I thought I'm looking at a certain ETF and it was trading at, 21, and I thought it was going to go to easily to 25, would I want to sell a 22.5 call? Would that make sense or not make sense? No. It would not make sense, because if my forecast was that it was going to go to 25, I should either sell a 25 call or not, or just maybe buy a call option, or definitely just be long the ETF and not sell this option. So it comes down to the relative value of receiving income versus the obligation of now having to sell that ETF at that strike price that I sold. So why would I consider covered calls? Again, because I think the market is expecting a bigger move than I'm expecting, essentially. At least that's the way I look at it. If I think the market is going to be quiet and everybody else is thinking that the market's going to move, well, then it might be a perfect environment to be selling some call options or some put options, depending on your selected option strategy. If you are doing covered calls, you're targeting increased rates of return. You're willing to tolerate underlying price risk. Now, this third bullet point, some people might say, but Steve, you're actually taking less risk if you sell this call option. And that's true in some regards, because let's say I bought this ETF for 21 whatever, and I sold a 22.5 call. I am going to take some premium in, but again, now I'm obligated to sell that ETF at 22.5, and maybe I'm not really hedging myself if that option is only selling. For example, today, the 22.5 call, the March month, is trading at about 45 cents. So I'd have to, and there's no right answer on this. Does it make sense to obligate myself to sell the ETF at 22.50 for 45 cents? Because I'm only gaining 45 cents. But if it doesn't move, I might be able to sell this option, the 45-cent option, many, many times, maybe 10, 11, 12 times in a year, and that could be quite a good deal of income. So I have to balance the risk. But if it falls, remember, I'm only getting 50 cents of a hedge here by doing the covered call. And I'm just using one example. There could be other covered calls too. And I'll go through some other examples in a brief few moments. Question from Tin, do I plan on being called out on your covered call? In fact, yes, you should. If you think about it, that should be, in my humble opinion, your target sell spot. That maybe in your mind, that is a nice resistance area. That's a spot that you wouldn't mind losing your asset at that price. Yes, I think you should plan on being assigned. It's not always going to happen. Sometimes the asset's going to fall, and sometimes you might want to even roll your position, which means buy back the option that you sold, maybe even at a little bit higher price, so you could continue to hold your underlying ETF. So remember, theoretically, the greater the perceived risk, the greater the potential reward. A few considerations. The risk is an ETF itself. So if I buy this ETF for $21 and I sell an option, well, most of the risk is in that underlying ETF value. And if the ETF rises above that strike price, as well, I'm going to have losses from the short call that's going to offset profits from the ETF. I want you all to keep in mind, in fact, it's a different topic for a different day, and I hope you're enjoying today's presentation. Since I've spent so many years, I really understand options theoretically and practically very, very well. And so I get into a little bit of the theory side of it. So this is in slide 29. We're talking about perceived risk changes each day. So today's market, after we saw the market move about 1.6%, if this was the curve for FCG, tomorrow's curve might look a little bit like this, meaning that the volatility has gone up today, that the amount of uncertainty has expanded a bit. If you notice, this area is expanded versus this area. So option premiums would increase in increased uncertain periods. So if I believe that the market was going to stay range bound, I might want to use this covered call strategy because I believe that we're going to be in a quiet market. What could go wrong? What's really important when you're looking at options is to think about not only why the strategy would work, but why it wouldn't work. So why would the strategy not work? If I do a covered call, and I'm going to pose this to all of you, what's the worst thing that could happen if I do a covered call? And if you take nothing else away from this presentation, this is the point I want you to, thank you, Tim, that the price moves down substantially. So if I buy this asset at 21 and it goes to 15, and I sold a 22 call for 50 cents, well, I have a huge loss. I might have lost 5.5 on that. Tina, sorry. Hi, Tina. I thought it was Tina. Substantial. So if you're looking at covered calls, where's your downside? If the market breaks down substantially, you're going to have losses. If the market stays in a narrow range or moves up a bit, you're going to be in a good position. This payoff diagram illustrates what I just pointed out very, very well. And Bill Alex, I don't know if that's your name, Bill Alex, but he says covered call is equivalent to a cash secured put, and yeah, it really is. It's going to look pretty much the same way. We're not talking about selling puts today, but you're right. So what do I want to occur? Well, what I love to see is I love to see that we sort of stay in this range here. If the asset rises substantially, I'd have been better off owning the asset because here I can't make any more money. But I do want to get called away. So Yael says, yeah, I want to get called away. Well, remember, you do and you don't because it's the asset. If I'm wrong, let's say I think this asset can only top out at 22.50 and it goes to 28, I might have been wrong. So yes, I got called away early. You need to understand that there is a benefit to selling the option, and that's the premium that you would receive. The drawback, though, on selling this option is that you have the obligation to sell those shares at the strike price. So let's discuss a few covered call strategies using the First Trust ISE Revere Natural Gas ETF, and that symbol is FCG. So Jason says, I think of a covered call as getting paid to sell a security rather than putting it in a GPC order at a higher limit price. Everybody, Jason, good point. Yes, some people teach that it's like leasing your stock out, your ETF out to somebody else. They only want to buy it when it goes up in value, so you might want to do that. You're sort of leasing. You're the owner, and someone else is leasing their stock, the call buyer. Tina has a question. She says, I presume that you want the volatility to be high when you sell the call. Yes and no, Tina. I know this is a really, and I get this question so often. What you really want to see after you put the trade on is not much movement. So let's say you sell a low vol and the volatility goes lower. Are you happy or sad? The volatility is low and you sell an option and then we see even lower volatility. Would that make you happy or sad? You'd be okay, right. So you can know that, just be aware that just because vol might be whatever it is today, it is when you're trading these options, it's a forecast of what's going to happen in the future. So it's not good enough to say, okay, vol's high today, I'm going to sell an option, because if vol's high today but it's going to go higher, that might not be a good trade. And if vol is low today and it's going to go lower, it might not be a good opportunity to buy an option. Understand that. We have different strike prices. In the money have the highest probability of remaining in the money. They are also the most expensive in nominal terms. In the money options have intrinsic value, followed by the out-of-the-money options that offer the most leverage. Option buyers love those out-of-the-money options because you can buy a lot of them, but they have the lowest probability of expiring in the money. Where we see the most volume in the industry is the at-the-money option. It is a hybrid between the in-the-money and the out-of-the-money option. These options have no intrinsic value, but they have the ability to get some intrinsic value pretty quickly, and that's what's also called gamma. So let's take a look. I built this slide over a year ago when FCG was trading at 1922. So you look, using this example of 1922, where are the in-the-money options, the at-the-monies, and the out-of-the-money options? Just type it in. Well, if we're looking at calls, if the asset's trading at 19, what's in? Yep, Tina says 19 is at. Great. What's an in-the-money option? That's right, the 17. Thank you, Tina. Thank you, Gregory. And the out of the money? Going to be the 21, correct. Which is the best to buy? In, at, or out of the money? Yale says in the money. The answer is, Gregory says in the money. It depends, guys. It depends on how quickly the asset's going to move up or down. If it's not going to move all that much, Peter says that's a trick question. It depends on your forecast. If you think the asset isn't going to move all that much, the option to sell is the at-the-money option because it has the greatest extrinsic option premium. If I think it's going to move up a bit, I might want to sell the out-of-the-money option. And if I think it's actually going to move down a bit and I'm long the asset, I might want to sell the in-the-money option. And it's always about, Yale points out, risk and reward. Thank you. I hope you guys are enjoying the presentation. As it's, at least as far as the ISE is concerned, I really don't deliver that many presentations. I'm more of the host. So I hope you're enjoying my flavor of all of this. Yale says I'm doing well. Thank you. Implications for buyers and sellers. Call buyers are predicting higher prices. Thanks, Tina. Call sellers are predicting stable to lower prices.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.